In the previous video, I explained the lease, type of lease, and I explained how we can evaluate a project with operating lease. In this video, I'm going to explain the capital lease and the project assessment considering the capital lease. First, I'm going to review the lease and type of lease. So lease is an agreement between lessee and lessor. Lessee is the person who uses the property. Lessor is the person who gives the property to the lessee to be used by lessee. In previous video, I explained that there are two main types of lease, operating lease and capital lease. The major differences between these two leases is in the operating lease, lease payments are allowed to be expensed in full amount. They can be deductible in full amount from revenue as tax deductions. We assume that in the operating lease, the ownership of the property stays with the lessor. So in the end of the period of lease, the lessee returns the property to the lessor. Because the ownership is not transferred, lessee cannot use the depreciation for the asset, and salvage is not applicable to lessee. The other type of lease agreement is the capital lease. In this type of lease, the ownership is transferred from lessor to lessee. The interest portion of lease payments can be deductible from revenue as tax deductions, not the whole of that. Depreciation, because the ownership is transferred to the lessee, can use depreciation to take advantage of tax deductions. Lessee can use MACRS method, and again, because the ownership is transferred to the lessee, lessee can salvage value is applicable to the lessee project assessment. So let's work on this example that in previous video we calculated the project assessment for the operating lease. Here we are going to evaluate the project based on the capital lease. So assume as a manager you want to decide whether lease or purchase the asset. If you purchase the asset, you need to pay $200,000 at present time. The salvage value is going to be $60,000. This asset is going to generate revenue from year 1 to year 5 with $100,000 of revenue from year 1 to year 5. The asset is depreciable using MACRS 5-year half-year convention. So depreciation can be applied in table from year 0 to year 5. If you decide to lease this property using the capital lease method, the annual lease payments are going to be $60,000 from year 1 to year 5, and the interest, the annual interest for the lease is going to be 10%. So this is the summary of the problem. The capital cost is going to be $200,000 if you buy the asset. Salvage value of $60,000. Annual revenue is going to be $100,000 from year 1 to year 5, and the operating costs are going to be 20, 25, 30, 35, and $40,000 from year to year 5. Tax is going to be 40%, and minimum discount rate is going to be 16%. The effective annual interest rate for the capital for the lease is going to be 10%, and capital lease payments are going to be $60,000 per year from year 1 to year 5. So this is the table if this is the project assessment if we purchase asset. I explained that in detail in the previous video. If we purchase the asset, the NPV is going to be $20,221. Now let's see how we can evaluate the project considering the capital lease. So the first step in evaluating a project with capital lease is calculating the present value of all capital lease payments. So we have 5 capital lease payments from year 1 to year 5, and the lease interest is going to be 10%. So we can use factor P over A or this equation to calculate the present value of all these 5 payments of $60,000 at the lease interest rate of 10%. So the present value is going to be $227,000 and 447. Then after calculating the present value of lease payments, we can calculate the depreciation. So this present value of lease payments is going to be actually intuitively is going to be the present value of the capital cost that we pay for the asset. So we multiply that by the depreciation rate that we read from table A1, MACRS method, 5 years depreciation half-year convention. These are the rates that we read from the table, and we multiplied in order to calculate the depreciation for each year. We multiply these rates by the present value of capital lease payments that we pay. So we multiply, for example, for the present time, we multiply this present value by the 20%. This is the depreciation at present time. Same method for year 1 to year 5. Present value of capital lease payments multiplied by the rate, and this is the depreciation for year 1, and so on. In the next step, we have to calculate the interest portion of each annual lease payments. This part might be a little bit tricky, but this is not hard at all. This is the equation that we use to calculate the interest and the principal portion of each payment, each annual payments that we pay for the lease. So every year we pay $60,000 of capital lease payments for the asset, and in the end we are going to have the ownership of the asset. So a portion, some part of these $60,000 is the interest, and some part of that is the principal. So that's this is the equation that we calculate this interest and principal portion. This is very important because interest portion is deductible from the revenue as tax deductions, and the principal portion is the amount that we put as the capital cost for each year after we calculate the tax. So let's start calculating and see how it works. So for the year 0, we don't have any payment. payments are starting from year 1. So the balance is going to be $227,447 that we had as the present value of these 5 payments of $60,000. So for year 1, we are going to pay $60,000. In order to calculate the interest portion of this $60,000, we need to multiply the lease interest, which was 10%, multiply the balance of the previous year. So this is the balance of the previous year, which was $227,447. So 10% multiply this equals to $22,745 of interest for year 1. So from $60,000, $20,745 is the interest portion, and the rest is the principal. So in order to calculate the principal portion of this $60,000, we deduct the interest from the payment. So $60,000 of payment minus $20,000 something of interest that we calculated equals $37,255 of principal for year 1. And the balance equals the balance of the previous year minus the principal that we calculated here. And the remaining is the balance for year 1. Let's repeat this calculation for year 2. So in year 2, again, the payment is going to be constant, $60,000. The interest portion of this $60,000 is going to be 10%. The lease interest multiply the balance of the previous year, which was $190,000, 192. 10% of that equals to this $19,000, almost $20. This is the interest portion of the $60,000 at year 2. If we deduct this interest from the payment, the remaining is the principal. So payment $60,000 minus the interest that we calculate here gives us the principal portion of the $60,000. In order to calculate the balance, balance equals the balance of previous year multiply the principal that we calculated here. The remaining is the balance for year 2. We do this calculation for year 3, year 4, and year 5, and we have this table. Please note that if you calculate everything correctly at year 5, in year 5 you must have the balance of 0. So if this is not 0, you should check your calculation, something is wrong. Another double check mechanism is the summation of all principal should be exactly same as the balance that you initially had. And it makes sense because you are paying off the this lease, this loan, and they should be exactly the same. Now let's enter these data in the table and evaluate the project assuming the capital lease. So year present time to year 5, revenue $100,000 from year 1 to year 5, and the salvage is going to be $60,000 in the end of year 5. The operating cost is going to be $20,000, $25,000, $30,000, $35,000, and $40,000 from year 1 to year 5. The interest. So these interest portions are the ones that we calculated in this table. So these are the interest portion of these lease payments of $60,000. So these are deductible from revenue as tax deductions. So going back to table, these are the interest portions. These are the interest portion of the $60,000 of lease payments that we have. Then we add the depreciation that we calculated before using the present value of lease payments. Then we calculate the taxable income, income tax, and net income. We add back the depreciation with positive sign. And another important point here. Please note that the capital cost is the principal portion of the lease payments. So going back to the table, so this column is the principal portion of the $60,000. So we have to enter these as the capital cost for each year if we have capital lease. Please note that in the purchasing alternative, we had the capital cost. We entered that at the present time. But here we add these capital cost, which was the principal portion of the lease payments, to these row as the capital cost from year 1 to year 5. And another double check, the summation of these capital cost, these principal portion, and the interest portion should be equal to the $60,000 of the lease payments. And then we calculate the after-tax cash flow. And again, please note that for the $60,000 of capital annual capital lease payments, we break that down into two portions: the interest portion and the principal portion. The interest portion is deductible from revenue as tax deduction, and the principal portion is has to be entered in the table as the capital cost. And we calculate the NPV using the discount rate of 16%, which is going to be $53,000. And you can note that it has the and as you notice, it has the highest NPV among the purchasing, operating lease, and capital lease. So let me use Excel spreadsheet and work on this example in the spreadsheet and see how we can formulate such example. So I have the purchase alternative already here. I'm going to follow with the capital lease analysis. So the revenue, salvage, operating costs are going to be exactly the same. So I will just copy them here, and I will say capital lease. So now I have to calculate the interest and principal portion of these lease payments. First, I have to calculate the present value of all these 5 capital lease payments of $60,000. So year 1, year 2, 3, 4, and 5. Each year we are going to pay $60,000. So in order to calculate the present value of these five payments, I can just use the NPV function. Present value equals NPV. The interest rate for the lease was 10%. There is no payment at present time. I start from year 1. So this is the present value of all these payments. Now we have to calculate the interest and principal portion of these payments. So let me write the year here. So it is year 0, 1, 2, 3, 4, 5. So this is going to be the payment, which we start paying $60,000 from year 1 to year 5. Then the interest, then the principal, and balance. So balance at year 0 equals the present value of these lease payments, capital lease payments that we calculated. Then we go to the year 1. The interest portion of the $60,000 equals the 10% of the lease, the capital lease interest, multiply the balance. The principal equals the payment minus the interest, and the balance equals the balance of previous year minus the principal. For year 2, same method. So 10% multiply by the balance of previous year. The principal equals the payment minus interest, and the balance equals the balance of previous year minus the principal. And same for year 3 and so on. So we can just apply this equation. We can just apply this equation to the other years. And again, this cell is the double check cell. If we calculate everything correctly, the balance of the last year should equal 0. And if I calculate the summation of all these principal, it should be exactly same as the balance of the first balance, the present value of all these payments. So next I'm going to calculate the depreciation. Again, I don't have much space here. I will write year 0, 1, 2, 3, 4, 5. The depreciation is going to be equal the present value of these payments, which is here. I will fix that. Multiply the rates that I had it from the table. So these are the depreciation from year 1, from present time to year 5. And then I'll start adding them to the table. So the interest portion of the annual lease payments are deductible from the revenue as tax deductions. So for year 0, we didn't have any payments. For year 1, it is equal to this value. For year 2, this value. For year 3 equals this value. and so on. Year 4 and year 5. And then I will enter the depreciation, which is negative sign with starting from year 0. I refer to this year. And then I will calculate the taxable income. Taxable income, which is the summation of this row. Then we will calculate the tax, which was 40%. And then net income, which is the summation of these two. I add back the depreciation, depreciation with the positive sign, so I will multiply this with a negative sign. So I'm going to have this one. And for the capital cost, as I explained, so we have to enter the principal portion of these payments as capital cost. So there is nothing at year 0 because we didn't have any payment at year 0. For year 1, negative sign, the principal portion of the lease payment is the capital cost that we pay. For year 2, the principal portion at year 2. For year 3, the principal portion at year 3. For year 4, the principal portion at year 4. And for year 5, the principal portion at year 5. So there is a very important, please note that, so from year 1 to year 5, your interest portion reduces and your principal portion increases. So your interest portion decrease, your principal portion increase from year to year 5. So this has a very positive impact on the project. So as you can see here, these interests are being deducted from the revenue. The big interests are being deducted from revenue as tax deductions in early years, and the principal, the principal, because it is increasing, so we are paying less principal, we are paying less capital cost for the property in early years. So because these higher capital costs are farther away from the present time, they are going to have less effect, and the total effect, because these negative numbers are far from present, it is going to have a very good and positive impact on the project. So let me calculate the after-tax cash flow. So after-tax cash flow is going to be equal the summation of these three rows, and and the NPV. And in the end we calculate the NPV. Here, because we have a payment at present time, we have to enter that manually. We can use the NPV function for the rest, 16% of interest, and we use the NPV function for the cash flow from year 1 to year 5. You can see here this has the highest NPV among the other three alternatives that we had for the purchase, for the operating lease, and for the capital lease.